Have you ever wondered about common audit bloopers and how to address them? Hello, my name is Tarina Els. I'm a chartered accountant and a registered auditor. This training presentation covers key audit documentation and review tips that would help you address the most important areas when finalizing audit files, from planning all the way through to reporting. This includes common regulatory inspection findings, aka audit bloopers, and how to address it properly on your audit files. Let's start with planning. The most common areas where auditors tend to forget their considerations, to document their considerations properly, are the following: ethical considerations, knowledge of the business, materiality, and risk assessment. Under ethical considerations, all auditors need to comply with international and local ethical requirements. The IESBA code issued by IFAC includes the following 5 fundamental principles: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior or conduct. Further to this, independence is highlighted as the most important area to consider. Typically, most firms would have a quality control manual or quality control policies and procedures that include templates or forms to complete when threats to ethical principles are identified. However, most auditors omit to record such matters on file. It is very important to document the steps followed to identify threats, the threats identified actually, and the safeguards applied to reduce the threats to an acceptable level. For example, when there are overdue fees outstanding from the previous audit, while the auditor is already busy on the next year's audit, it would typically be an independence problem. The auditor may have specific safeguards in mind, but it is critical that all of these considerations are clearly recorded in the audit file to show how it was considered and how the threat was addressed. In another example, where an audit team member has an independence issue due to a personal relationship or financial interest or something similar, the team member may need to be removed from the audit altogether in order to eliminate this threat. The bottom line remains: all ethical considerations need to be documented instead of being ignored or simply swept under the carpet. Next up, knowledge of the business. Many auditors tend to simply answer checklists with a short description here and there instead of really properly understanding the entity and the environment that it operates in. Think about the economic sector. What is the entity providing or selling? How does the entity actually operate? Does it form part of a larger group or not? Who are those charged with governance and other key role players? Think of an organigram maybe to help you. What does the control environment look like? What about IT controls, transaction level controls? The best way to get the real detail is to ask management to provide detailed descriptions for you. And then, when you pitch up for the audit, you can simply verify it through discussion, observation, inspection, and other means. You can see that system descriptions are more important than you may think, because this is exactly where it is explained how the entity functions in detail for each of the major business cycles. It's important to cover all material amounts and disclosures and other aspects like journals and recording in this process. Otherwise, you and your team won't know enough about what you are auditing. Proper performance and documentation of walkthrough testing are also equally important. Actually go and observe the process. Inspect documents to verify that things are actually working the way they are supposed to. then only also think of discussion. You cannot only verify this through discussion, because you never know what's really happening on the floor. All right, so there's a lot of things to think about in terms of knowledge of the business and properly documenting really what's happening. What about materiality? Many auditors simply use the same basis of materiality as the past year or for similar audits without thinking whether it really applies to this year and this specific entity being audited. Think about what really applies to the entity. Document your reasoning then behind it. The same goes for whether to use previous year audited figures, current year unaudited figures, current year budgeted figures, or a combination of that. Still, this needs to be justified, properly considered. And if you get this wrong, it could bear much larger consequences, because you might be missing the point with your audit then. What's also important under materiality is not to forget to consider possible qualitative factors that could also be seen as material. Possible significant non-compliance, for example. There may be other examples too. Another common misconception about materiality is that it is determined based on risk. This is not the case, since it should actually be determined based on what would influence the users of the financial statements and their decisions made based thereon. So think what's important for them. It can be qualitative, quantitative, and ultimately you set a threshold that you believe would still be safe before it would start to influence the decisions of those users of the financial statements. Once overall materiality is set, then only does a risk start to guide the auditor, because then you need to start to set an appropriate level of performance materiality, which is used to determine sampling, and also perhaps a trivial threshold, what would be considered clearly insignificant for the auditor, and therefore inconsequential when concluding. Be very careful of the wording used when explaining your decisions surrounding materiality, that you don't contradict yourself. Be clear and be concise, but try to have somebody else read it if you want, just to see whether it makes sense. Another aspect that really can make or break an audit is risk assessment. The entire audit effort during planning bears down to risk identification and assessment. So let's try to get this right. It's critical that the auditor thinks of risk at financial statement level and significant risks at this high level, and whether there are specific overall responses required to respond to this. Clearly consider this, document your considerations. Then you must also drill down in your risk assessment all the way to the assertion level for each significant component, each area of the financial statements, and its related disclosures that you need to look into. Specifically think of areas of significant risk. How do you justify your decisions made? Why is it a significant risk? Which assertions are affected? Are you 100% sure that your assessment is correct and that procedures done in response to that would be appropriate to that risk identified? So you can see here it starts to link to the fieldwork testing. Once again, let someone else not involved in the audit look at your reasons and see if they understand your thinking and agree with your assessment. I believe that it's critical for an engagement partner to, at this point, already have a look at the file and then decide whether he or she is happy with the approach followed. because materiality and risk assessment is key. Okay. Let's look at fieldwork. What do we have to look out for here? Now, the most important concept during fieldwork, that actually also applies to the rest of the audit file, is the principle of re-performance. Here, in the middle, in red. The audit work performed and all the relevant considerations need to be documented in a way that another auditor would be able to understand what have you actually done and to be able to come to the same conclusion as you have. This means that the auditor's thought process clearly needs to be explained in the audit working papers in terms of all of these aspects that I'm listing. Have sufficient appropriate audit evidence been obtained for each and every assertion? Have all the risks been addressed? Think of your thought process applied, nature, timing, extent of the work performed. You can see at the top of the list sampling. This is obviously where it links up to planning. So you've got to be sure that sampling that you apply in each section is clearly linked to the risk as it was determined during planning. And if there are any adjustments during your fieldwork testing, that it's updated or extended accordingly. Think about the assertions and the objectives, procedures performed and conclusions. Are they all clearly linked? Are you using the right version of the assertions? Because remember, ISO 315 was updated relatively recently, and the disclosure assertions were moved and brought into assertions for balances and assertions for classes of transactions, with only a short list remaining for those disclosures that might not have been covered when testing those areas. Then think of what are the appropriate source documents. This is very important for fieldwork testing, because if you get the source wrong, then your entire verification exercise falls flat. If you're testing revenue, typically, a system-generated invoice are normally not the original source of revenue transactions. There may be an order, and prior to the order, there may be even something external to that. Preferably look at the first point of reference external to the system, that you can test there and assess whether that's complete, and then use that as the source, the reliable source, to trace transactions to the system. Same goes for when you're testing in the other direction for occurrence or existence, those type of assertions. When you trace something from the ledger to appropriate source documents, once again, you've got to have the right source documents, otherwise you cannot properly verify those assertions. All right. Now, I would also think of, did the auditor clearly explain in enough detail exactly what was done and when the work was done, or how the timing of the audit work was considered to be appropriate? Think of the period represented by your sample size when you have a sample. Think of how you're testing the balances at year end and movements in terms of that, and perhaps subsequent payments or receipts proving certain assertions. Have a close look at the timing there, that it is appropriate to what you're trying to achieve. Then make sure that significant risk responses are appropriate to address the risks identified, and was sufficient testing performed in response to significant risks. Go and look at your sampling methodology of your firm. Make sure that you're testing enough when it goes around testing significant risks. Next, you think of professional skepticism. Were there judgments, misstatements identified, Is there audit evidence from other audit sections? Does it correspond to what you found here? What about just your overall conclusion for this section? You need to apply your professional skepticism here, and your documentation needs to reflect that. Your thought process once again. Further, think of misstatements that were identified specifically. Are these individual misstatements that's non-recurring, or is it possible repetitive errors that might have a larger impact that requires extrapolation? Think of whether the misstatements are individually material, or perhaps in aggregate together with others, or within the same section. How does it look like now? Does it maybe require further extension of the sample being tested before you can conclude? All of these are prominent aspects to think about. I've mentioned earlier the assertions relating to disclosures. It is very important, and it has been flagged as a very specific focus area over the past few years, that financial statement disclosures are not always properly audited and properly considered. Are all the disclosures made that should have been made in terms of this section? Are all the disclosures that were made relevant, appropriate? How about the classification? The way a financial instrument is disclosed, is the classification there correct? What about current versus non-current? Liability versus equity? And then also the narrative disclosures that goes together with it. What about contingent liabilities? Think of all of these things and make sure that everything and all aspects have been addressed and considered and documented. Now, a last key point that I like to highlight under fieldwork is the cash flow statement. This is sometimes not properly verified by auditors, or only partially verified. This is a very prominent and material part of the financial statements. Even though not everybody understands what it's about, it's still important and material, and you have to verify it properly. And when you test cash and cash equivalents, you would not necessarily test everything that you're supposed to test with the cash flow statement. That would only provide you evidence about the opening and closing balances and perhaps some of the movements in the cash. So think about, yes, recalculating the cash flow statement. Think about classification between cash flows from operating activities, investing activities, financing activities. Are all of these appropriate and relevant to the specific business? Because it can differ between different entities. Think about dividend reflected as dividends paid in the cash flow statement. Was this only declared, or was this actually paid? Because if it wasn't actually paid, it shouldn't be reflected in this particular statement, but should only be disclosed somewhere else and should be eliminated from here. So document all of this clearly on the audit file to support this material disclosure. All right, enough said about fieldwork. Let's move on to finalisation. Oh, I see I forgot one point there. Working paper reference. You might think it's very small, but do you know how important this also is for the principle of re-performance? It actually helps to show how the auditor considered risk, then the procedures, then what the actual work was, what the conclusion was, how that draws back to a finalisation. So think of these things. Where you refer to another document in file, make sure that there's a clear, proper cross-reference to make it easier to follow the thought process and understand what the auditor has been up to. All right, let's dig into finalisation. What's important here? This is the most critical area of the audit file where everything should be pulling together to support the audit opinion expressed. let's start at the top. Evaluation of misstatements is very important, and obviously this pulls from what you've identified from fieldwork. It's important to consider misstatements individually and in total together with others. You've got to think of whether misstatements are indicative of fraud. Does it point out specific control deficiencies that need to be reported to management and those charged with governance? What about attaching ultimately the final list of uncorrected misstatements to the management representation letter that needs to be signed together to prove that management is comfortable with these remaining misstatements and that it's not material for them? Okay, next think of non-compliance. Obviously, first thing that should come to mind is NOCLAR in terms of the ethical requirements. That means non-compliance with laws and regulations. That's what that acronym stands for. And in different local contexts, there's this concept of reportable or material irregularities, where some of these are reported, which goes hand in hand with NOCLAR considerations if the matter has followed all the steps and the auditor concludes that it needs to be reported to somebody specifically, maybe to a regulating body, to get addressed. Other matters that need to be formally reported to those charged with governance and management need to be considered. These are normally where most of the matters that need to be reported to them come from, but you might find a few additional things. Okay, let's think about going concern. Obviously, this was initially assessed at planning stage, but now the figures might have changed due to audit adjustments that the client passed. How do the ratios look like now? Have you looked at the final analytical review? Did it show you anything new? Did anything change? Are there subsequent events that all of a sudden came in that changed the way you look at going concern for this particular entity? What about management's forecasts and assessments for the next 12 months? What does that say? Are you happy that all material going concern uncertainties are properly supported by appropriate plans that management has put in place to make sure that the entity does not go under? You as an auditor need to show how you verified these plans. You cannot just accept, oh, there's a subordination agreement, but not document whether you've verified and you're satisfied that this will be enough to keep the company going. And if there are any going concern issues, think of the potential impact on the audit report. Okay, another thing in terms of subsequent events, I've already mentioned something on the going concern, but here you need to properly consider any subsequent events, follow all your required procedures, document what you've really done under each one in a performable manner, and then show whether you've identified any further adjusting events or disclosing events that might need to be adjusted for or disclosed for in the financial statements. Then, in addition, subsequent events working papers and the management representation letter need to be dated as close as possible to the date of the audit report, even on the same day if possible as the date of the audit report, but it must not be dated after the audit report. Alright, because if you date it after the audit report, all of a sudden you have introduced additional audit evidence. This is a big no-no. You cannot afford sloppy mistakes like this to catch you out. You're supposed to do all the work up to the date of the audit report, and then based on all of these things that you've considered, you conclude appropriately, and you issue your audit report. Okay, so when you think of conclusion considerations, think of all of these matters that I've specifically discussed, but also think of any additional concluding considerations. Think of key auditor matters that might need to be included in your audit report. Think of other matter paragraphs that may possibly need to be included when there's other information published together with the audited financial statements. And think of the possibility of material inconsistencies between these two, the audited financial statements and the other information. Depending on what there is, you may already have to just include some sort of wording in your audit report. Think of whether there are any other matters that need to be emphasized. Perhaps an emphasis of matter report is in order. Remember, though, that other matters and emphasis of matter paragraphs cannot be included to try to avoid an audit qualification that should be there. Lastly, think of your actual audit report wording. Have the standards open next to you. Look at it word for word and make sure that you are addressing all the relevant aspects and using the correct wording as far as possible. Okay, I've said a whole lot of things about what should be documented. But let's think. What should be reviewed on the file and when should it be done? Should you mostly perform audit file reviews during planning and then only finalization again? Should it be done throughout fieldwork? Perhaps a combination of all of the above? Let's see. Key focus areas for review of the audit file is the timing, the scope, and evidence of such review. It depends from audit to audit. It depends on the size of the audit, the length of the time spent on each phase of the audit, the size of the audit team involved. But the main principle from ISQC1 and ISA 220 is clear. The entire audit file needs to be reviewed by someone. Even if juniors are involved to review others' work to some level, and then the next level kicks in, and then the partner reviews only key areas. Still, all the working papers need to be reviewed. Then, another principle coming clearly across from the standards are that the review should be done at appropriate times during the course of the audit, and that there should be clear evidence of these reviews performed. Okay, once again, on a large audit, timing can maybe easily be managed. Once planning is done, let's review all the planning. When certain fieldwork sections are done, let's review that. And then at finalization, we pull it all together and review the finalization working papers in the context of the rest. But in simpler, smaller engagements, it might not be as practical to split it this way. And maybe you will have to only do a high-level review of planning of key areas initially, and then later on look at everything that you haven't looked at yet, together with the fieldwork and the reporting. It's just ideal to try to split it up so that and review earlier if possible, so that there's time for the team to adjust their approach before the next phase of the audit is started. Okay. This session was done on a very high level, focusing on documentation and review areas, but there are many areas that can be dealt with in more detail. Please note that there are focused practical webinars scheduled and coming up soon in the coming month and future months to focus on some of the aspects addressed today in more detail, using practical examples, real-life examples. Please go and have a look at our website for more details. If you have specific training needs or specific training topics that you want to be covered, please let us know so that we can arrange the training that is customized to your firm. Do you perhaps need more guidance, specific advice, or further assistance? Once again, contact any of our specialists via our website and we will gladly assist. Please also leave a comment on this video or contact me on social media. Thank you very much for listening. Goodbye.